Welcome back. Tuesday morning on the floor of the New York Stock Exchange. The indexes are all up in this moment. We're going to talk about today's session with my guest on the floor. That is Mark Otto, designated market maker at Knights Capital Americas. Mark, welcome back.
Thanks for having me back.
So, Mark, we are on our 21st consecutive positive Tuesday. I don't know if that's really relevant, but of course it's relevant that we are still up after a very bad Friday last week. Yesterday we recuperated a lot of the ground, and we are still going up today. Of course, economic data are still in focus.
Absolutely. I think yesterday we saw a lot of volatility come back into the market. I mean, the market was up 100 points, then it was down, and it rallied towards the end of the day. There was definitely a divergence yesterday between the Dow Jones, the S&P 500, and the NASDAQ. Towards the end of the day, it almost seemed as though with that last hour rally, the Dow actually dragged the S&P higher.
And what does this tell us? I mean, it's still a lot of nervousness in the market. I mean, people are really preferring strong, big companies with good dividends compared to small and medium caps or technology.
Absolutely. I mean, this past quarter, the earnings, they weren't necessarily a catalyst to the upside. However, they didn't drag as well. So I think that people are continuing to be cautiously optimistic. However, later on this week, we're going to have a lot of jobs data. I think that's going to be in the focus. Particularly, people are very concerned on what's going to happen with QE3 and how soon we're going to get weaned off it. And a lot of that might have to be reflected in what's coming out with the jobs reports.
And of course, we know that the focus is on the Federal Reserve because we keep listen to all these speeches that come from Federal Reserve members. And we had one yesterday that actually a good comment, a positive comment that reinforces the fact that the Federal Reserve is still behind QE3. And of course, as you were saying, the data on Friday, well, tomorrow and on Friday on the job market will give us more hints on what the Federal Reserve could do.
Absolutely. Next couple of days, we're going to be looking at the ADP numbers tomorrow. We're looking for a forecast of 165,000, and that's up from 119,000. Moving on to Thursday's initial jobless claims, 345,000. That's down from 354,000 claims. Moving on to Friday, we're going to have the non-farms data. So we're looking for 168,000. That's versus 165,000. They're anticipating that the unemployment rate is going to remain the same. That's at 7.5%. So if everyone's going to be, I think, more closely watching this information than they have before, simply because the reflection off of this data could impact QE3. $85 billion a month is what they've been spending on U.S. Treasuries, and it seems as though most people think that they're more than likely going to wean off it. They'll probably cut it down to about $50 billion. In a more extreme measure, they could pull back entirely, but most traders that I speak to don't believe that's going to happen.
And the timing of it, I mean, what do they think is going to happen? Is going to happen in June, in September? I mean, before summer, after the summer?
I don't believe it's going to be more of a time thing. I think it's going to be more of them closely scrutinizing the macroeconomic data as far as the labor market and the jobs reports. So I think that's going to be more of a tell sign than time itself.
Probably they need more data. A good maybe full 3 months of data can give us the idea and give them the idea, of course, on how the job market is performing.
Absolutely. I mean, for a long time they were saying 6.5% on unemployment. So you'd have to think that coming into the end of this week, 7.5 unchanged is what they're looking for. However, if it does creep closer to 7, it's going to be very interesting to see how the market reacts. I mean, is bad news good news? Is good news bad news? How is the market going to react? You would think that, the way things are, that if they decrease the QE3 and start weaning off it, that's a bullish thing. It means that long term, the economy is actually stronger now, and it could withstand, any blows that might come because of it. You might see a knee-jerk reaction on the front end. It might be a buying opportunity just because of that. We're really going to have to see, but the market's definitely skittish. You could sort of feel it. Yesterday was a good example.
And when in this volatility, also, to monitor the levels is a kind of nerve-wracking. I mean, I know that on Friday we went down pretty steeply, and we have touched a lot of important technical indicators at technical levels. So now give me some number. Which are the levels for the S&P 500 we should monitor closely in the next few days?
Right now, we're actually at 1645 1642 is a level coming down from here. It's going to be 1630, 31, and then 1625. So on the upside, it's going to be 1652 and then 1660. So keep an eye on those levels the next couple of days. I'm sure that we're going to see a little ping-ponging around, reacting to all this news coming out.
A great ride. Thank you very much, Mark, for being with us.
Thank you.
And thank you very much for watching.